Good morning, good afternoon, good evening. Hello, everybody. It's my pleasure to welcome you to our webinar today. I'm Ann O'Brien, CEO of CFA Society San Francisco, and I'm welcoming you to our 10th annual Global Portfolio Managers Panel. We're thrilled to have such senior level executives in the investment industry sharing their insights with us today. You will all be muted for the webinar, but are encouraged to ask questions by typing them into the Q&A box. We will endeavor to answer as many as possible. It is now my pleasure to introduce our speakers. We have Marina Batliwalla, who is Principal and Senior Investment Consultant at Mercer, Saira Malik, who is Chief Investment Officer at Nuveen, and Henrietta Pacquement, who is Portfolio Manager, Head of Global Fixed Income, and Head of Sustainability at Allspring Global Investments. And our moderator today is our very own Angie Pena, who is the President of the Board of Directors of CFA Society San Francisco. With that, I'd like to turn this now over to Angie. Thank you, Angie.
Thank you, Ann. Thank you, everyone, for joining us today. Thank you to our esteemed panelists, and also thank you so much to our title sponsor, Allspring. Support from sponsors like Allspring make our programming what it is today, a leading organization in the investment management industry. So we're going to spend most of our time covering markets and career. As far as markets, we'll comment on areas of concern and opportunity, artificial intelligence, ESG, and other megatrends. As far as career, we'll hear about each of our panelists personally, their passion projects and inspiration. So with that, let's start the discussion on markets. There are many markers that indicate we are transitioning to a new paradigm. I'll start with Marina. What are you seeing with your clients as they look to manage portfolios? Are there any meaningful risks that you're guiding your clients to avoid, that they're not seeing, and what are the areas that you're suggesting they lean into?
Okay, thanks, Angie. I work with a very broad range of clients, from endowments and foundations to pension plans and defined contribution plans. So from an industry perspective, in relation to our clients themselves, we're seeing a lot tighter staffing models within themselves, having to manage with a lot less headcount and wanting to focus on their own core competencies. And that's really leading us to see significant interest in growth in our OCIO, or outsourced Chief Investment Officer consulting model, where the clients delegate more of their fiduciary responsibilities and risks to us. In the defined contribution retirement plan space in the United States, this has been an extremely litigious environment with no end in sight. And this is really preventing innovation in this space. And our challenges there are related to how do we help individual participants succeed when each individual has their own individual goals and risk profiles. So those are the sort of broad industry themes. But if we want to focus on portfolios, private markets is a theme and an area with strong return potential, but only as long as clients are comfortable with fees and the illiquidity surrounding them.
Great, thank you. Henrietta, from your fixed income and international vantage point, where do you see the most risk in the near term, and where are you finding the most opportunity?
Well, I'm going to take the other side of what my colleague mentioned there. We're actually seeing a lot of interest in public markets. If you look back a few years, we've come out of years of financial repression. And finally, we're seeing yields in the public markets. And I think that really is drawing investor interest, and they're having another look at their fixed income portfolios, and notably that public side. So I do think that there are a number of opportunities that are opening up in that space that investors are looking to exploit. Now, it's not going to be plain sailing, and we've seen a bit of that over the course of this year. Yes, there are opportunities in the forms of higher yield, but I think the environment is changing there. You were talking about paradigm shifts. We do think that in the fixed income space, we are seeing a new regime away from low or negative interest rates to a more normal environment at this stage, and also a move towards markets having to find prices on their own, and I think that's what we're seeing in some of the volatility, particularly over the last couple of months. The central banks are stepping back and letting the market price risk in a better way than it has in years. We'll talk about growth prospects a little later on, but that is also something to keep an eye on at this stage.
Sarah, what about you? From your vantage point as CIO, you continue to see good companies manage around whatever visibility they have. What might be areas of concern and areas of opportunity?
Well, I'll talk about what's outside the traditional 60-40 portfolio. So by that, I mean, traditionally, investors have held a 60% equity, 40% fixed income portfolio. And it's no secret that last year, that portfolio was highly correlated and did not give investors the diversification that they wanted. I've been in the industry for almost 30 years, and a lot has changed since I entered in fixed income equities and real estate, where mostly the only choices you had to go into. Now there's a host of alternative asset classes. And the good thing about both of those is they can provide two benefits to investors. One is that many of them are beneficiaries of inflation, and the other is that they can be resilient to the economy and, of course, less correlated to other asset classes. So, for example, farmland and timberland, other asset classes that are institutionally available, have beaten CPI on an annualized basis from 1991 to 2021. Farmland 8.5% over CPI, timberland about almost 7% over CPI. So both of these asset classes can benefit from inflation, which we know is here to stay for quite a while. And then areas that are less resilient to an economic slowdown, like infrastructure, the backing of infrastructure is utilities and waste management. We're upgrading our infrastructure in the US as globalization becomes more localization, infrastructure less resilient, and also private credit, an area of the market that's become, has had very fast growth in the last decade or so. If you look at history, private credit tends to outperform during a downturn. So again, asset classes that can help solve that 60-40 problem that many investors had in 2022.
Great, thank you. And then Marina, there was some mention, right, on unique views from Mercer on EM in China. What might you add more a little bit there?
Sure, yeah, and I'm not sure they're unique, but happy to share them. From a structural perspective in a diversified portfolio, we believe it makes sense to at least have a neutral weight to emerging markets. But having said that, being overweight emerging markets requires a really long-term perspective, as you're going to have to withstand a lot of volatility versus a benchmark such as ACWI, the All Country World Index. So in the short term, say 1 to 3 years, you're going to have a lot of tracking error when it comes to emerging markets. There are so many risks, governance, geopolitical, macro. So active management is critical in that space. In terms of China, we do think that not investing in China is a strong active call, especially if you're measuring yourself against a benchmark, a standard benchmark.
Yeah, I think, is there anything to add from Sarah and Henrietta that you would think about, just further areas of overweight? Anything to add to those comments, please?
Sure, I'm happy to add. I agree on the comments on emerging markets. I think there is some interest there on our end, especially outside of China, but we're watching China closely. We are seeing more signs of stimulus in China, growth starting to recover a little bit. So I don't think that China is going to be an asset class that's out forever. And many portfolio managers are fairly significantly underweight China at this point. So if they start to resume their growth rate similar to what they have in the past, I think you could have a strong snapback in China. But other emerging markets have actually been quite interesting. Latin America further ahead than the US in its battle against inflation. So further ahead, that monetary policy curve is a good thing. Other areas like Indonesia, which is a very young population, has been growing quite quickly. And Mexico benefiting from that trend of moving our manufacturing back closer to the US or inside the US. Mexico is a big beneficiary as one of our main trading partners. So all of that, I think, is very, there are signs of hope in emerging markets, and the valuations are much cheaper than the US.
Yes, I'd echo that. And I think, we were talking about alternative asset classes, and we were talking about diversification earlier in the call. And I think that fits that category. We are seeing a dispersion in terms of growth prospects. If you look at the US, if you look at Europe, if you look at China. So having exposure to multiple areas helps in terms of building efficient portfolios.
Do you see, I mean, right, we're seeing this narrow market leadership, obviously in the US. Where else might you see kind of the next tier of companies and or opportunities that you'd highlight, right? Instead of, everyone talking about what is mainstream, how would you take that the next level down or the next area?
I'm happy to touch on that. So, it has been a very narrow market for the first half of this year until about this summer. It was just a handful, about 10 technology stocks that were driving the entire stock market. It had broadened out a bit since the middle of the summer. And then, of course, now the markets have become very volatile based on geopolitical issues, fears of inflation, decelerating at a slower rate than we thought, and the Fed holding interest rates higher for longer. Now, I have been bullish on technology. We as a firm have been since for all of 2023, and we remain so. So partly that narrow market in some ways deserved to be the outperforming segment of the market. Tech stocks underperformed significantly in 2022. They are long duration types of stocks, so they benefit when inflation is slowing and when we get to the end of Fed rate hikes. So we were going to see that in 2023. So it makes sense that they would be outperforming. And then, of course, artificial intelligence, which I think is an actual trend, not just hype, another boost for technology stocks. Now, other areas that may start to catch up, though, we talked about emerging markets, a cheap, beaten down area of the global markets that could have a trade. Also, small caps are at some of their cheapest levels on a valuation basis versus large caps than what we've seen in 2 decades. If we don't have a deep recession this year and go more to a soft landing or a mild recession, I think small caps could have a catch-up trade. If you look at history, when they trade at this level versus large caps, something like 13 of the last 14 times, they have significantly outperformed for a period from here.
And I think that's a good transition, right? As we're talking about, I think we're going to cover some of these topics very broadly, and then there'll be more opportunity for discussion. But as we think about kind of technology and the research platform at Nuveen, Saira, what are some of those artificial intelligence techniques that are being leveraged regularly, and how has that benefited clients in your perspective?
Happy to discuss that. So artificial intelligence tends to need a lot of information in order for it to be very efficient. And for those of us who are investing, we're generating tons of information, using tons of information all day long. So first of all, as a research analyst, it really can make an analyst more efficient in terms of all of the information that they need to go through in order to better understand their company. So a productivity boost for your research analysts. For portfolio managers, and at our firm, our portfolio managers and our analysts directly manage money. So this applies across the board for us. All of our trading history, artificial intelligence can help analyze that and make us better investors. So looking through me, I am a global portfolio manager at the firm. My trading history that I've been managing money basically for all of my 28-year career, what am I good at? What are my biases? What am I bad at? AI could really be helpful in terms of helping me become a better investor. Across the board, I think there's an urgency for companies to implement AI techniques into their business models because it helps boost productivity and should help also drive your revenues. So I think that there is an urgency to this. There's a very limited number of companies that are available to invest in the space. We know the names: Microsoft, NVIDIA, maybe just a handful of others. But over time, there'll be many more options for us to invest in. So I'm not surprised to see a bit of a digestion phase for investors who crowded into some of these mega cap and large cap companies that had AI exposure when it really took off from an investment point of view earlier this year.
Henrietta, commenting on that, are there certain areas within portfolio management, trading, risk management, and fixed income, similar to what Saira had mentioned, that you really appreciate and believe will justify the cost, and in what time frame? How are you thinking about that?
Yeah, I mean, it's a hugely powerful tool, right? And yes, the boost is in productivity. It doesn't necessarily replace processes, but it just makes them more efficient, and it gives you better insights in terms of behaviors, in terms of information, in terms of sentiment as well, from a market perspective. So those are all elements that we're exploring from our side. And just to give concrete examples, you were talking about research analysts and how that could be used. It can be a great tool to sort of help shrink a universe into, thematics that are going to be relevant for investors, and get insights into various sectors and companies that way. We're going to talk about sustainability later. A huge amount of data coming out from a sustainability perspective. Again, that lends itself well to AI tools to extract information there. And I think if you look more broadly at asset management and some of the challenges to the sector, frankly, that are going on at the moment, it can help as a tool for efficiency from the way you manage your business. I'm thinking of certain processes around clients, around responding to RFPs and so on. These are all tools to enhance efficiency at a corporate level as well that we're looking at.
And then Marina, how are you seeing your clients leverage different types of artificial intelligence that have been the most helpful in managing portfolios? And then we had also discussed, some of the internal work going on at Mercer as well.
Yeah, sure. Well, Saira and Henrietta just gave us fantastic examples from a manager perspective. AI can be segmented into two classifications: predictive AI, which classifies, categorizes, analyzes data, and predicts future based on past on the one hand, and then generative AI, which creates new content and draws inference on the other. And it really impacts our clients in four main ways. So the first one is managing risk through compliance tools and risk management models. The second one is with clients themselves, improving their products and their customer experience. We see that reporting is going to become faster and more interactive, so client decisions will become more dynamic. Thirdly, through costs, we talked about operational efficiencies already. And then finally, from a manager perspective, alpha generation, looking for those automated insights and differentiating factors. So as we know, managers have been using predictive AI and machine learning for years and years, but generative AI really has the potential to transform the middle and the back office by reducing costs and improving efficiency. Internally, if you'd like me to touch on that. So I think this is really interesting. We are currently testing an internal version of ChatGPT, so that's being tested. And looking outwards, we at Mercer are going to be launching a survey in November for asset managers to ask about their processes for generative and predictive AI and the impact that they're seeing on themselves and the economy. And we'll be releasing those results early next year.
I think that'll be an interesting study. Do you know of any other consultants that are embarking on this type of study?
Not right now, but I wouldn't be surprised. I mean, it's going to be a topic for the future, right? So,
yeah, absolutely. So this may be an interesting one, Henrietta, Marina. I don't know if you have any, thoughts here regarding. Obviously, policy is new. Policy is evolving, both, with respect to artificial intelligence. We know that it can be used in a variety of ways. What might be some ways your respective firms think about, values, AI, and how to incorporate that? Again, policy is new and emerging, but I'm wondering if you have some thoughts there, regarding values in AI.
I can give a first stab at that one. Yes, I think it's something that's very important to take into account, and we've got a dedicated team looking at that aspect. It's a question of looking at how we use it, how we use it interacting with the outside as well, and how we create the boundaries between sort of AI within Allspring and AI interaction with the outside. And I think it's also a question of thinking about what checks and balances you can introduce when using it as a tool, as a portfolio manager or otherwise. What kind of quality control do you want to have around it to make sure that the insights are really valuable to what you're doing from a portfolio management or an efficiency perspective. So I think personally, we're still at the infancy of what it can do, and there's a lot to discover and a lot to try and test and to make sure that we got the balance right at this stage. And that's something we're paying a lot of attention to.
Marina, is there anything that you're specifically paying attention to at Mercer, or just?
No, I think obviously we're launching this survey to understand the impact on the industry. I think internally we're very aware of the opportunities and the risks. You hear about these hallucination effects and those kind of things. So, yeah.
Sarah, what other mega trends are you thinking deeply about at Nuveen, right? We've covered a little bit of artificial intelligence. We'll touch on, we're going to touch on sustainability in a little bit, but what other mega trends are you really paying attention to?
Sure, I'll talk about a couple. First one is the shift to renewable energy is accelerating. In a number of years, renewable energy will be our #1 source of energy that we use. And what does it mean? Partly the commodities that go into the shift to renewables, like solar and wind, these commodities like copper, cobalt, lithium. We've been underinvesting in many of these commodities for many years in the US. For example, for copper production, in the last 25 years, our production is down about 50%. So I think the bridge to renewable energy, that path is going to be a long one, and the US needs to become more prepared in terms of the commodities that it utilizes to move to these much more climate-friendly renewable energies like solar, wind, and other types. So that's one that I think is important. We're going to need to increase our infrastructure in the United States in order to support the electrification of the grid. So infrastructure is another mega trend that I think the investment in that will last for many years. Also, debt levels in the US and even consumer debt levels are something we need to think much more seriously about, given where interest rates are and the probability that they stay higher for a much longer level of time. Many think that when we came into this year, a lot of people thought we'd be looking at rate cuts by the end of 2023. Of course, we're not looking at that, and I don't think we're looking at them for the first half of 2024. So when you look back at history, post the global financial crisis, the average federal funds rate was a little bit under 1%. For about the 50 years pre the global financial crisis, the average federal funds rate was close to 6%. I think what we're going back is to more of a pre-GFC world, not the post-GFC world. I'm not saying that rates will stay at will be at 6% for decades, but just on average, a higher level than we've seen in the past. We've not had these levels of debt in the U.S. That we have today, that we've had in many decades in the past, and consumer debt levels are high, and you're seeing that you're seeing that impact with a significant increase in auto and credit card delinquencies by consumers. So I think that's an issue we need to keep a close eye on and think about. And then other areas of the market that weren't really investable areas or as easy to invest in 20, 30 years ago, alternatives and the illiquidity there. So private credit, private equity, some of these harder asset classes like farmland, timberland that I mentioned, I think the returns on those have to compensate for the liquidity that you add to your portfolio with them.
So before we move on to sustainability, any comments, right, on higher debt levels, higher interest rates from both Marina and Henrietta, and then we'll move on to sustainability.
Yeah, sure. So, in terms of key investment themes, the fixed income regime change is definitely one of the things that we're focused on. That makes us revisit asset allocation of our clients. The frontier's, a little flatter now with that, and we're looking at opportunities in credit and emerging market debt. And then the other one is structural inflation pressures remaining. So that's due to resource demand, supply chain realignment, and impact of climate. So those are all additional themes.
Henrietta, comments on higher for longer?
Yes. Higher for longer. Yeah, I think we are in this sort of stage of higher for longer. I do think, yes, you're right to point out that it's higher for longer with a lot more debt in the system that we've had historically. So that will be something that is interesting to see play out over time. Absolutely, we think climate is a big driver, and I would go broader than the conversation that we've just had in a minute on that front. But certainly it is going to be one of those drivers that is going to keep inflation higher than maybe we've seen over the last 10 to 15 years. And valuations need to reflect that at this point.
So let's dive into, your views on climate, right? As head of sustainability at Allspring, I know you have some views there, how to tackle it, given your London domicile, and kind of what you would advocate for as a good approach.
So, our approach is really to sort of think about it as a transition. It is something that is going to impact not just actually the energy sector and not just the grid. We think that it's a lot broader than that. It's going to impact building materials. 8% of global emissions come from the cement industry. How is that going to adapt over time? If you look at the competitive landscape in the auto sector, that's changing. The whole sort of supply chain and economics of cars, ICE vehicles versus EVs is different, and that is creating a challenge in the sector that is going to play out over the next few years. It's also changing dynamics between geographies, and different geographies are tackling it in different ways. You look at the US and where they are at compared to where Europe is, where sustainability themes have been more prevalent for a longer period of time. You look at developing markets and China and the role they need to play there as well. And it's interesting to see China actually being very well positioned in a number of sectors from a climate perspective going forwards. And it'll be interesting to see how that plays out. So very much a thematic to be taken into account when building portfolios, looking at risks, but also looking at opportunities as a result.
Marina, I know you have some thoughts there.
Yeah, I think, as it relates to, sustainability, I think the distinction between what is happening in the US and outside the US is really interesting. In Europe, especially UK, regulation is driving sustainable investing with the Sustainable Finance Disclosure Regulation, or SFDR. And pensions in the UK have had to issue disclosure due to the Task Force for Climate-Related Financial Disclosure. They have to disclose climate-related risks. So we've been helping clients with climate scenario analysis, which can be very technical. With all this legislation overseas, it's more of a sense of having to apply, whereas in the US, our clients act out of a sense of conviction, all with different motivations and what is material to the performance of their portfolios. So, for example, endowments and foundations have fewer fiduciary restrictions than, say, defined contribution retirement plans. So what we do is we help them understand what their mission is, how that applies to their portfolios, and we have a very nuanced view. And in addition to that, we apply ESG ratings to investment managers across all asset classes. We've been doing that since 2010. And those ratings provide clients with an additional level of information as to how their managers are integrating ESG or not. And we evaluate ESG-focused managers, and in fact, all managers. We look at return potential over a full market cycle, not just ESG. And so, we know that leading edge managers are focused and they clearly express how ESG can better add alpha in their portfolios.
So maybe a subset, right? Commenting respectively on DEI, right? Also thinking about evaluating managers from an ESG perspective, maybe trying to dive into that DEI process as well, Marina.
Sure. Well, as a firm, we believe that an inclusive firm drives innovation and business success. So that's a core value for us. In terms of managers, we've amassed a lot of information on managers ourselves for clients who want to evaluate managers from a DEI perspective as well. So we work with plan sponsors themselves to survey managers to understand those managers' DEI practices at their own firm and the investment process. And some clients will actually have dialogues with managers about furthering equity and inclusion based on that. So that's an interesting aspect. The other really interesting thing we're doing, I think, is with defined contribution plans. So we have partnered with plan sponsors to evaluate the demographics of their workforce. And we've developed these things called personas to better understand how participants are using their retirement plans. And we segment participants by ethnicity and gender and look at behaviors that can help plan sponsors give additional guidance or benefit to various people to help meet their needs. So, for example, we can look at different sectors and see how hardships or loans, withdrawals or contribution rates vary, or if their investment allocations aren't appropriate, we can help them target that more effectively.
Fantastic. Any other comments from Saira or Henrietta on DEI? I know it's a broad topic. I'm not sure if you would like to comment on how your firms are looking at it, engaging your associates, et cetera, any firm policies, et cetera, that you would call out there.
I mean, we look at it, both as a corporate, as Allspring, and how we look at our workforce and the trends, and making sure that we have the diversity, as you were mentioning. We do feel that brings different points of view, and as a result, it's certainly in a portfolio management space, better opportunities to construct portfolios. But we also look at it from an investment point of view, and looking at it in our investee companies. It's a source of engagement as well, that we have when we interact with these investee companies.
Yeah, I think Henrietta is summed up very similar to us. We look at it from a corporate level, from an investment level, and from our investment team level. It's no secret that I think that diverse teams, diversity of thought, diversity of education can help people think differently. And of course, oftentimes investment returns are generated from those who aren't thinking like consensus. One, I'm very passionate about educational diversity, which is, working with Wall Street. Actually been working with the CFA Society of New York in terms of getting Wall Street to widen the funnel in terms of the narrow range of schools that they tend to hire from, because I think there's a lot more diversity at a broad array of schools, and we'll get more diversity of thought in our investment teams because of that. As a firm, we always make sure that we have diverse slates when we're hiring. We've partnered up with other firms like Ariel to make investments in diverse managers and diverse companies. We also do that through our Churchill private credit and private equity division. So I'm very passionate about it from many angles, from a corporate level, also making sure we have diverse investment teams. I think that does produce stronger results. And so those are some of the areas that we're looking at.
So you led me right into this, personal section too. So before we open it up for broad questions, I wanted to hear more from our panelists, personally, your passion projects, the inspiration behind them. Sarah, you were just mentioning, educational diversity. I know in our past sessions, you've mentioned your non-traditional path, attending Cal Poly and then Wisconsin for your MBA. How has that personally influenced your style and passion projects?
Sure. So I talked a little bit about going against the grain and how I think a lot of times we can generate the best returns and opportunities that other people have missed. A lot of my background has a lot to do with that. So maybe 2 points I'll make, which is about learning to invest in yourself and also investing in others. So as you mentioned, I grew up in California, in Stockton, California. And when I was in high school, I went to my guidance counselor to ask him what I should do after high school. And he told me he didn't recommend that I go to a 4-year college because he didn't think I would make it through. So I didn't listen to him. I went to Cal Poly in San Luis Obispo, and I fell in love with the markets, mostly thanks to my mother, who was a medical doctor. And I got my Series 7 in '63 when I was 19 years old and started publishing my own stock market newsletter. And when I graduated from Cal Poly, I thought, well, I've already been doing this as a teenager. I'm going to go to Wall Street. And I applied to 20 Wall Street firms, and I didn't get a single interview. I just got those polite form letters back saying, no, thank you. We're not interested in interviewing you. I was fortunate. I did go get my master's at University of Wisconsin-Madison, and firms hired from there. And I did get the one spot that JP Morgan Asset Management had in equity research for someone from UW-Madison. And that's how I started my career. So one thing was, learning to invest in myself when others won't was very important to me. And then maybe I'll just go back to investing in others, and even a sub point of that, of erasing negative data points ranging from what my high school counselor told me and my ability to overcome comments such as that. But I mentioned my mother was a medical doctor. She loved the stock market, but she was a medical doctor. So why did she become one? Well, my parents were from Pakistan, and my grandmother back then from India. And my grandmother wanted to be a doctor. And when she wanted to go to medical school in India, they told her she can't go because they don't allow women into medical school. So she eventually went to medical school and was in one of the first classes that allowed women. I love her, drive and her story, because in my office, I have her medical school diploma, and on it, the hymns are crossed out and replaced with hers. And next to the an S is written in, because when she graduated from medical school in 1934, they didn't actually have medical school diploma for female doctors. So she became a doctor. My mother decided to follow in her footsteps. And when my mother wanted to be a doctor in the US at that point, she went to her counselor and she said, I really want to be a surgeon. And the counselor said to her, I don't recommend that you become a surgeon because patients won't be comfortable with someone who sounds like you and looks like you as their surgeon. And I'd love to end the story and tell you that my mother became this fantastic surgeon, but she didn't. She was an internal medicine doctor for her entire life until she graduated. And it's just another example of you need to make sure that you find other people to invest in you and help show you a path and light the way, because you can't do it all by yourself. And it's important to tell people what they can do, not what they can't do. Erase those negative data points, because I think many people fall along the wayside if they're told too many times that this is not something that they should be pursuing.
I think that's great advice. You know, so much influence from those close to us, and, you know, to try and seek those other opinions. And so let's talk about some of those opinions, Marina, that you've seen in your podcast and working with financial literacy and young women. Talk to us about that particular passion project.
Great, thanks. Great story, Sarah. I love that. Firstly, I'd just like to mention that the podcast is independent of my work at Mercer, and the views in it are my own. Having said that, you know, I come from a family where for 4 generations, we've placed a great importance on the education for women. And 4 years ago, I started teaching financial literacy to my daughter's scout troop. And we teach them all the basics: spending, savings, compound interest, debt, credit cards, insurance. But what really made a mark on me was that it was the scouts' mothers who told me they wished they had had this knowledge and been taught this information. And I started to research this, and I found that studies also showed that a girl's financial literacy often comes from her parents, especially her mother. You know, what I found out is that research shows that there's not only a gender wealth gap, there's a gender confidence gap, and there's a gender financial literacy gap that needs to be addressed. So it was from there that I got an idea for a podcast where people, you know, especially women, could hear other women and experts talking openly about money through their real life stories in simple everyday language. So.
Fantastic. And Henrietta, such a different background, you know, majored in astrophysics and then transitioned over into asset management. Talk to us about that, because that's super interesting as well.
Yeah, different path. And I suppose, you know, just sort of bouncing off the 2 stories that I've just heard. Yes, in both cases, sort of challenging the sort of status quo. There weren't very many women in the astrophysics course, as you can imagine. I was a bit of an anomaly there. And then, you know, again in finance, sadly, if you look at the sort of percentage of female portfolio managers, is not as high as it could, or you know, we would hope it to be at this juncture. So in a way, challenging the sort of status quo in both areas. I would say that the drive for both is quite similar. You know, I love problem solving. I love you know, getting to see how things work, and you know, those were both the drivers for astrophysics on the more of on the sort of natural science side, and then financial markets. And I think that probably was the attraction to fixed income as well. You know, you're really looking at the plumbing of the economy, how companies are funding themselves, how governments are funding themselves, and you know, really how the nuts and bolts work. So I think that was the attraction there. And you know, the message there is really try it out. And you know, talk to I wouldn't necessarily just say women in the industry. I would say to the men in the industry as well, the young girls looking for opportunities there, to see what it's like. And there are a number of different profiles, jobs that you know, will attract different personalities and different styles. And I think that's something not to be forgotten. It's not just portfolio management. It's not just banking. There's a whole ecosystem that women can go and explore on the financial side. And it'd be lovely to see more of them in the industry.
It would be. So let's go to a few audience questions that have surfaced here. The first one is, right, we haven't quite talked about black swan events. what is maybe a black swan event that you think is being neglected by the media, right? We've alluded to some of the debt levels, et cetera, but like even more so, what do you think is possible to occur in the next 12 months that we haven't touched on? Who wants to take?
Sure, I can start on it. I'd probably say there's two areas. One is exactly something breaking due to the level of debt and interest rates that we are dealing with in modern society. We've already seen that have a very significant impact on commercial real estate. And, I think there could be more things to break. Second is these ongoing geopolitical issues. They bubble up very quickly from different regions of the world. We're dealing with one very tragic one right now, and it does potentially have market impact. It's already impacting oil prices. And, oftentimes these types of issues can tilt you pretty quickly into a recession, depending if it doesn't stay contained and keep spreading throughout that region of the world. China, Taiwan is another area of the world that, at any time I think could bubble up and become a much more serious issue. The unfortunate ongoing conflict in Russia, Ukraine. But I think all of those geopolitical issues, when we think of a black swan event, it comes up very quickly, very hard to predict when it'll happen, even if you think it's a potential possibility. That is always, the pandemics, geopolitical issues, the debt level. We've known that is an issue for a long time, but now interest rates are another factor in that equation that are making it much more front of mind.
Yeah, I would agree with the geopolitical. That's the big unknown. You never know where it's going to come from. So
I wouldn't necessarily think about it necessarily in a black swan view. What I think is challenging at the moment, I think it's challenging for the markets, is that you've got a number of issues bubbling up. Be it in terms of geopolitics, be it in terms of sort of areas of the market that are under a little more stress, as you talked about, given debt levels. So for me, it's more the accumulation of these events that might look regional initially, but you've got more and more regions impacted going forward. So I think that's something that is making markets a little challenging at the moment. And it's in a backdrop, you were mentioning about underinvestment in certain areas from a commodity perspective. We are in a situation where certain areas of the supply chain are a little fragile, are under tension. So it doesn't take much to sort of move prices and to have an impact on financial markets.
And then similarly, factoring recession into your allocations, how might you guide the audience as you think about your own portfolios and decisions there? How does a recession factor into your asset allocation?
Well, our view is that we're in the late innings of this economic cycle. And, there's certain areas like the employment markets are not flashing that at all. But I mentioned the consumer and their significant levels of debt and the delinquencies that we're seeing. And given all the Fed tightening and the fact that they're leaving the door open for more rate hikes, we do think there's still probably one more rate hike on the table, not in November, but in December of this year. I think all of that does eventually lead to some kind of recession or end to this cycle. So we're positioning in quality areas. What I mean by that is companies with strong balance sheets and strong free cash flow. Also areas like infrastructure that are more resilient to an economic downturn. Looking at areas that have lagged, like dividend growers. These are companies that consistently raise their dividend. They've not been an area that's been of interest this year because of what you can return on cash, but generally they outperform in down markets. And I think people will be seeking that income, because another thing that happens when the Fed finally pauses on rate hikes is that the returns on cash will decay. And our clients are saying they have about 25% of their portfolios in cash. And I think that cash is going to start to move back into the market and say, where can I earn returns that outpace the risk-free return I'm getting on cash?
Yes, we haven't talked about cash. Cash is interesting again, right? So much cash on the sidelines. Where would you propose, that next opportunity, or thinking about that next opportunity, both in the near and maybe the longer term?
I think, a couple of things with cash is, one, people tend to mistime the market. So that's one issue with holding on to too much cash. while I do acknowledge that the returns on cash, of course, are quite favorable right now. But if you go back to the pandemic, just the most recent market downturn, people tended to get out of the markets right when it started. And then they were out in March 2020 when the market bottomed and took off, and then they basically chased the market back all the way up. So I think that often happens. If you look at history, people tend to get in and out of the markets at the wrong time. So how do you leg back in an intelligent way? Well, first of all, we need to find asset classes that have returns that are above cash and compensate for the risk that you're taking. I mentioned private credit, for example, that has tended to outperform public fixed income, but yields on public fixed income, even though it's been beaten down so much because of the rise in interest rates, the yields on public fixed income, many areas like municipals, investment grade, you can get yields that are above what you can earn on cash. And then in the US, in equities, I think US tech stocks actually still look interesting. We talked for many reasons why, not just artificial intelligence, but inflation moderating and the Fed coming to the end of its rate hike cycle in the near future. And then looking for lagging asset classes, which we touched on, like emerging markets, small caps, and dividend growers, where you can get some valuation support in areas that should see a rebound for many reasons when some of this pain starts to move out of the way.
Marina, Henrietta, just comments on allocations, recession.
Yeah, I mean, our clients tend to be very long-term investors. So we're talking 20, 30, 40-year time horizons. So from the point of view of recession, I think just, one thing we do for them frequently is model different economic scenarios. Recession is always one of those. So it's just a question of them being cognizant of their liquidity needs over shorter term time horizons and adjusting portfolios as necessary. But they're really focused on a very long-term time horizon. And so cash, we had the cash conversation, but cash tends to be a very small proportion of their portfolios.
I think maybe to add to those comments, agree with many of them, we have seen flows into cash, and it is a competitor actually to many asset classes and has been over the course of 2023. But investors, I agree, should be looking to look at the other areas of the interest rate curve, the credit markets. That being said, you don't necessarily need to be a hero. You were talking about yields. Yes, if you look at investment grade, that's over 6% now in dollar terms, in sterling terms, and even the euro market. You're nudging up towards 5%. These are pretty interesting levels for companies that have got decent balance sheets going at this point. I think security selection is going to be key. We've come out of a low default environment on the credit side. We don't have the sort of same central bank put as we've had in past years. We expect defaults to pick up. So I think doing your work and making sure that you've got business models that work in a high yield environment is going to be key, particularly for credit portfolios going forwards.
I'm getting notice. So we're going to go through our last speed round really quickly on questions, and then I'm going to summarize and say thank you. So speed round. Thank you so much again for the time, sharing your perspective. I changed the question a little bit. So we'll say, what has been the most valuable aspect of being a CFA charter holder? Sarah, I'll start with you.
I got my CFA so early in my career now, in my 20s. I worked on it when I was in school. And, for my non-traditional background, it was just such a helpful tool and badge of honor to have. So people really understood that I have the skill set to do the job. I'm serious about doing it. I'm really happy that I got it at a very young age, even before I entered the workforce. And that was invaluable to me, to just sort of show people this is really what I want to do for a living.
Marina?
When I came to the United States from Australia in 1999, I was qualified as an actuary, but I was very interested in an investment career. So the CFA, which is what I did when I came, gave me a fantastic both depth and breadth of the investment markets and knowledge of the United States. But it also gave me a globally recognized designation. So it was fantastic.
Well, I did it just after my degree. Right, from astrophysics straight into the CFA, given that I was starting out in the financial industry. And as you said, it's a fantastic introduction to the world of finance, to how companies work, So it was really a sort of ground level for me to start to my career on the financial side. So I would thoroughly recommend it early on in a career, just to sort of cement that knowledge.
Fantastic. So we have covered a fair amount of topics, areas of concern, areas of opportunity, commented on artificial intelligence, ESG, sustainability, other megatrends, etc. Thank you so much, ladies, for the time today. I'm going to hand it over to Anne.
Thank you, Angie. Thank you so much, Marina, Saira, Henrietta. It was a wonderful conversation. And Angie, thank you for moderating and managing to fit so many diverse points of view, so many subjects into our short time frame. Our attendees really appreciate it. And finally, I very much want to thank our title sponsor for the event, Allspring Global Investments. Without your support, we would not be able to make this panel happen. 10th annual Global Portfolio Managers panel is now complete. Thank you so much, everybody, for attending. Thank you again, speakers and moderator. See you in a year. Bye-bye.
Thank you.
Bye.
Thank you.